We request to see Venkata Subramanian to introduce about this speaker.
Good evening everyone. I am Diamond Jubilee. I am here to give a short introduction about Mr. DHRUV, who is a resource person for today's session, CP session on international taxation. So, KUMAR is a chartered accountant and he is associated with the People Consulting firm and he is specializing in tax and regulatory services in the consulting firm. He has over a decade of experience in advising companies on tax and regulatory matters. Sir basically specializes on domestic and international tax matters and advising clients on corporate restructuring, tax due diligence, inbound and outbound expansion, etc. We welcome, on behalf of everyone, I welcome Mr. DHRUV for today's session. Over to you, sir.
Thank you, sir. We request to see KUMAR sir to present another two speaker. Thank you, sir. Handed over to speaker.
You're all able to hear me anytime, even if I don't use it. So I will use it as needed if you're not able to hear me. So, firstly, thank you all for taking time out to attend this session today. It's a wonderful initiative by SIRC to get us together for this kind of a back to basics kind of a session on this topic. Now, international tax per se is a very vast subject and has enough and more content to fill not even just a movie, but say like a web series with 10 to 15 episodes per season running up to several seasons in itself. And therefore, what I've attempted to do here today is not just give you even a trailer or even a teaser, but it is just to give you like a first look to that subject. So in that context, before we jump into what is international taxation, let's maybe spend a minute looking at why do we even need international taxation. Historically, tax systems in the world have followed these two basic tenets. Residence-based tax systems, countries that adopt this system typically tend to tax individuals or citizens based on their residence in a particular country. So the connecting factor for these kinds of tax systems is the personal attachment of that individual in that particular country. Typically, if you take India itself as an example, if you are a tax resident of India, then your global income is subjected to tax in India, irrespective of where you are from. On the contrary, source-based taxation regimes are countries which tax incomes only if they emanate from a particular source within that geography. So here, the connecting factor is not the personal attachment of the individual, but the economic benefits that that individual receives within that jurisdiction. Singapore, for example, is a classic example of a country that follows source-based taxes. Even today, if you earn foreign incomes in Singapore, they are not subjected to tax until you repatriate the incomes in Singapore. So, as countries grew, as borders began to shrink, cross-border transactions began to emanate, etc., obviously conflicts started coming into what kind of taxes would the country of residence impose on a particular transaction vis-a-vis the taxes that the source country would have to impose on a particular transaction, especially if these transactions cross geographical borders. I'll give you an example. Typically, if you look at any such cross-border transactions that could be subjected to double taxation, we could capture these elements in these two broad themes. Now, economic double taxation is typically a scenario where the same item of income or the same transaction is subjected to tax in the hands of two different individuals at the same point of time. Let's say Virat Kohli owns an IPL franchisee in the US. This franchisee runs a series of successful tournaments, gets a lot of income. After paying local taxes and expenses, there is a surplus that is left over which is repatriated back to Virat Kohli in India. This profit is already subjected to tax in the US, and when it comes back to India in the form of a dividend, it is again subjected to tax in the individual's hands. So the same item of income is getting taxed twice in the hands of two different taxpayers. This is economic double taxation. Juridical double taxation is a scenario where the same individual is subjected to tax by two different countries on the same transaction. So in the same example again, if Virat were to go to the US and play a T20 match, he earns match fees. The US would also step in, invoking their right to tax that income because he has earned it there. India would also seek to exercise their right by saying he is a tax residency, and thus these kind of conflicts arise. So the source-based taxation vis-a-vis the residence-based taxation, coupled with the nature of income, the place where the income is earned, the residence of the taxpayer, etc., all began to give rise to several conflicts, especially in relation to the taxing rights between two different states, in terms of how each state should take their fair share of tax revenues. This is where the concept of international tax began to gain prominence. So essentially, this is not a global set of common rules or a specific different law, etc. It is just a uniform set of principles that aim to put in place a fair and harmonious means for countries to share taxing rights on incomes where both countries can have an equal right to taxes. This therefore typically boils down to how countries, by virtue of their domestic laws and by virtue of other bilateral negotiations, are able to give this relief to people. If you look at the Indian tax context, Section 90 of the income tax law gives the government of India the power to enter into double tax avoidance agreements with other countries. I'll touch upon what these treaties agreements are in a minute. But essentially the scope and purpose of this agreement is to provide a relief from these kinds of double taxations that we spoke about. Essentially the treaty would be the base document within which the scope and the right of each country to tax that income would be agreed. Having said that, the government would also ensure that the treaty does not become a tool for avoidance of taxation in entirety. So in as much as it prevents double taxation, the objective of the treaty is to also ensure that double non-taxation is avoided. Essentially, you don't use the treaty as a means to go shopping in terms of which jurisdiction can be a favorable bet for you to earn income and not pay any taxes. The treaty also serves as a mechanism for recovery of taxes for the government in situations where there is a element of income that accrues outside India or vice versa, and the government wants to exercise a power to get more information about that income and then use it for recovering taxes. So the treaty therefore is a statutory power given to the government by the law to be able to negotiate this with other countries and essentially use it to provide relief in cases of double taxation. The unilateral relief provision under Section 91 essentially gives the government the power to provide a credit unilaterally, which means in cases where I don't have a tax treaty with another country. Say for example, today India does not have a treaty with say Bhutan. In those cases, if I earn an income there, India has the power to give me a simple credit of the tax that I have already paid in Bhutan against my India taxes, so that I don't end up having to pay taxes twice on the same transaction. So essentially, paying tax once itself is a big headache for honest taxpayers. These measures ensure that there is no more onus placed on these payers to pay taxes, ensure that only fair share of taxes are paid. Now, I spoke about the concept of tax treaties and how that forms the basis for bilateral relief between countries. Now, essentially, what is a tax treaty? As I touched upon, it is nothing but a simple agreement in its purest form between two countries. The competent authorities get together, list down a set of incomes that they believe would be common between both these countries. These could be active incomes. Companies of one country set up business in another, earn profits, repatriate those profits, etc. And passive streams of income. These could be royalties, fees for technical services, capital gains, those kind of transactions. The treaty therefore sets out essentially the rights to both these countries for taxing these various streams of income and how each country would impose a cap in terms of the rate or the amount of taxes that it can collect on this particular. So net-net, the treaty is governed under the Vienna Convention on the Law of Treaties, which is again a set of uniform principles basis which treaties are negotiated in good faith between countries. And it also serves as a means to interpret what kind of powers and what kind of relief will two countries get when using a tax treaty. The treaty also serves as a means to ensure that there is a rational allocation of taxes between jurisdictions, at the same time ensuring that tax discrimination is avoided. Tax discrimination essentially means if you were to give a resident of your country a beneficial treatment, you should not deny that treatment to a resident of another country merely because he is a foreigner in a very colloquial sense in your country. This is also a mechanism inbuilt into the treaties to ensure that there is no discrimination between taxpayers, and to that extent any benefits that you get by virtue of being a resident of the other country is also given to you by virtue of you being a non-resident. As an example, basically, if you are entitled to say a particular kind of exemption from a transaction that you do in an overseas country, if you are a tax resident of that country, this exemption by virtue of the treaty should also be given to you even if you are not a resident there, as long as you satisfy other conditions and parameters within the treaty. So net-net, it becomes therefore a very more powerful document than even the domestic tax laws. If you look at it from the prism or lens of a non-resident who is coming to India to do business, say there is a Singapore company that wants to come into India and do business. It does not have to go through all the 275 sections under the income tax law to understand what would be its compliances, what kind of taxes it has to pay, what other aspects it has to be mindful of when doing business in India. It is sufficient if it goes through the text of the tax treaty to be able to understand what kind of rights India has on the incomes that it earns in India, what kind of withholding tax or other taxes that it has to pay in India for its transactions, and then confine itself to only those limited set of rights and parameters. So in that sense, the treaty becomes a very powerful tool, as we spoke about, to ensure that double taxation is avoided, at the same time also ensuring double non-taxation is avoided.
This is in Vienna Convention. The rule that you said, is it in Vienna Convention or not?
No, so the Vienna Convention is basically a set of uniform global principles. If I have to take a very crude example, I would equate it to an accounting standard or an IFRS. It sets out common parameters, and on that basis treaties get negotiated. The rule that I said comes inbuilt into treaties. We are talking about the non-discrimination rule. Right? That comes as an inbuilt feature into the treaties.
So what are the incomes that are liable for taxation and what are the incomes that are not liable for taxation? Is it an income tax act or?
So for your particular question, the Income Tax Act also placed on the exemptions and tax treatments for certain categories of income. The tax treaty sits on top of that to say, here are the tax rates or the tax benefits that you get for these categories of income. So if there is an interplay amongst the two, there is a set of rules on what prevails over the other and ultimately what should be given to the taxpayer. I'll touch upon that in a minute, but I'm sort of covering that. So I spoke a lot about the supremacy of tax treaties, how it is very beneficial, etc. But essentially, as the treaty by itself is an agreement, okay, a lot of work has been going into drafting a model base for this agreement that is followed by different countries. Well, I put some text, jargon on the slides. Interestingly, the very first tax treaty was signed way back in 1899. That formed the basis for countries to start agreeing with each other to say, across my borders, this is how I will tax income and capital. And from there on, right from 1928, with the League of Nations convening a finance council to start drafting a model basis of tax treaty, there has been a lot of work that has gone into putting in place a framework that all countries can uniformly agree to and abide. This is just to ensure that the interests of different kinds of economies are taken care of. Different kinds of countries may have different views, but all of them ultimately should coalesce into a common objective of ensuring a fair and equitable allocation. So from that basis, the League of Nations had done a lot of work between 1928 to 1946 to put out several drafts of model tax conventions. Post this, the OECD, or the Organization for Economic Cooperation and Development, which is today the base authority for all matters relating to international taxes, took up the initiative to update these drafts and release its own model version of a tax treaty. Now, the OECD model is typically skewed towards developed countries and economies, and it provides more emphasis for the state of residence to tax incomes. So, it would basically, if you see an OECD model treaty, certain articles or certain definitions would be more skewed to the country of residence, giving them the right to tax these incomes. For example, a permanent establishment would be more narrowly defined to limit the rights of the country of source and provide more rights to the country of residence to take back taxes on these incomes. In parallel, the United Nations also took up the initiative to provide a set of model tax conventions or a set of model tax articles for a tax treaty with the objective of taking into interest the tax requirements of developing countries. The objective here was to encourage inflow of investments into developing countries by providing a more beneficial tax regime and also putting in place their tax interests to shift the tax incidence to the country of source. India follows a hybrid model. It leans more towards the UN model in order to protect its own tax base, encourage investments into India, and also ensure that the country of source, being India, gives a proper amount of taxes. But at the same time, where required, it also adopts the OECD model to ensure that it does not give up any specific right that it has to otherwise give. All of this in one side, the US as usual has its own series of objectives and principles with its own model treaties that its internal Department of Treasury puts up for negotiations. The US model per se is not drastically different from the OECD or the UN model. It is just that the US model has a set of more additional safeguards to ensure that treaties with other countries do not end up misusing the US treaty, and the aspects that countries have to satisfy to get access to the US tax treaty with that particular country are far more robust and secure. Now, I spoke a lot about the what of a tax treaty. What is it? What was the basis for it? What kind of model treaties came out, etc. So, also touch a little bit upon the when, who, and how of a tax treaty. Now, as I said, a treaty by itself is an agreement. Essentially, therefore, it's a contract. And as any contract, it will also have a start and an end date. Now, any amendment under the domestic tax law, for example, comes with a specific date. It can go back in time, it can become prospectively, it can start in the middle of the year, etc. A tax treaty, being an agreement, has to follow a specific set of procedures. Therefore, the date of signing of the agreement by both countries by itself does not mean the treaty becomes effective. The treaties has to be signed. Both countries have to follow their domestic law procedures for notifying the treaty. These could be by way of gazette notifications in India, corresponding notifications in the other countries, etc. Once all these procedures are completed, both countries through their diplomatic channels have to notify each other of the completion of these activities, and it is only after then that the treaties come into effect. So each treaty has a specific article called entry into force that lays down all these conditions and parameters, and specifically lays down therefore a date from which the treaty comes into effect. So you could have theoretically a treaty that is signed in 1999, but the activities required to bring it into effect drag on until say 2005, 2006, etc. And therefore the treaty comes into effect only after that particular event is done. On similar lines, the treaties also have a clause for termination. This is similar to any commercial contract. It provides for a minimum notice to be given through diplomatic channels for each party, and a minimum lock-in period, usually up to say a 5-year period, post which the treaty can be terminated again with effect from a particular date, insofar as procedures are properly followed. So net-net, therefore, the key takeaway for us should be, whatever kind of tax treaties you look at, and if new tax treaties are getting signed, the date of coming into force is a critical date for us to consider, because that becomes the date from which the beneficial provisions start flowing in for transactions. Now, if you look at the who aspect, fine, tax treaties are there, it covers transactions between two countries, allocates taxing rates, all are fine. But what kind of persons or what kind of entities can get this benefit? It is not always that you will have individuals doing cross-border transactions. Especially in today's world where structures have become very complex, you could have entities being set up as limited partnerships, limited liability corporations, trust structures, simple holding entities, SPVs, etc. So in all these cases also, there would arise a need for the treaty to specifically define the scope of the people to which it extends. So in essence, the tax treaty would have a specific article of residence to say what kind of persons are covered under its ambit. Well, natural persons are clearly covered as long as they remain a tax resident of the other country. The applicability of the treaty to legal entities like a partnership, LLC, etc. is to be specifically evaluated. I'll give you an example. If you take the US again as a jurisdiction, it has a very peculiar concept of a limited liability company or an LLC. Now, the characterization of an LLC for US tax purposes is very similar to a partnership in India, i.e., the LLC by itself can elect to not pay taxes. The partners of the LLC will end up paying the taxes. But at the same time, it retains the limited liability characteristics of an LLP in India. At the same time, if you look at the law, the definition of an LLC in the US and look at it from an India tax context, it will not meet the definition of a partnership for India or an LLP also in India, because the partners there do not have any specific liability or limited liability. The LLC has all other rights and obligations as far as similar to a private limited company, and from a company law or a US corporate law standpoint, the key features of an LLC mirror those of a private limited company in India. So the same vehicle in two different countries can be characterized in two different aspects. What is seen as a partnership for US, for India tax purposes could be viewed as a private limited company. And therefore, when these kind of unique aspects arise, how do you characterize what is that entity, where is it resident, etc. And then comes the tax system for that entity in the US. Again, if you take an LLC, like I said, the LLC can be registered in the US. It could have partners sitting out in, say, Cayman Islands, and it can have an option by which it would say that I will not pay tax, but my partner sitting in the Cayman Islands will pay tax. So whatever money the entity earns will not be subjected to tax in the US itself. In which case, how do you give the benefit of the US tax treaty to this entity if the ultimate persons who are paying taxes are not even residents of the US? All these kind of confusions and interesting complications, permutations will arise as we delve into this more. But suffice to say that the treaty will very clearly call out who will be eligible to take this benefit, and from there on it's an important aspect for us to evaluate if the benefit can be given. I'll give you again a practical example of how this can be relevant for us. Let's assume we are doing a simple form 15CA, 15CB for a transaction where our client is paying a US LLC a brand fee or a professional services fee. Right? If we don't look at this aspect, can the LLC by itself get the access to the tax treaty? Is it a US tax resident? Is the tax residency certificate alone sufficient, or should you go one step beyond, etc.? Signing off that 15CA by saying that the TDS that will apply would be the TDS as per the tax treaty by itself could become a big challenge for us. Right? So all these fundamental aspects also get interlinked with the concept, and therefore it is critical to evaluate these in holistically. That's the key thing. Lastly, the how. In how, what I wanted to convey was, merely because you satisfy the who, are you immediately getting a ticket to access the treaty? Now, merely because I am a resident of the US, can I go and say, look, I will therefore have access to the India-US tax treaty? Is it as simple as that? Historically, the law as provided for in the Income Tax Act and as upheld by the Supreme Court has been, you get me a tax residency certificate, I am more than happy, I will give you the access to the tax treaty. This used to be a very big issue for companies based out of Mauritius that come into India, because under the India-Mauritius tax treaty, capital gain transaction used to be completely exempted. So if you were to invest 1 lakh in India, it multiplies into 10 crores, you could exit India, not pay any taxes by simply producing this tax residency certificate document to say, I will get access to the tax treaty. While this has been the position of law settled by the Supreme Court, CBDT circulars and the income tax law, the way the tax department is looking at it now is not as simple as just a reliance on a TRC document. There is a lot of push and emphasis on, do you have adequate economic substance to justify your access to the treaty? What this means is, merely because you come to me from Singapore, show me a TRC, why should I give you the tax benefit? Do you have a presence in Singapore? Do you have office in Singapore? Do you have employees in Singapore? Do you have operations there? Do you have a bank account there? Are you able to show me that your people in Singapore are competent enough to take decisions on their own? All of these are aspects that I will want to see. Because if you simply come and show me a TRC, I would have all rights to suspect that you are only doing this to take advantage of the tax treaty. That's the way the thinking is shifting. That's the way the approach of the department is shifting, to question your access to the treaty itself. And once again, therefore, we would need to be ensuring that we have all our bases covered and our boxes ticked. If we give any such kind of sign off that yes, under the tax treaty you are entitled to a benefit, the lower tax rate is yours, the exempted tax position is yours, we can go. I'll pause here if you have any thoughts or reflections before we move on to questions. Right. So a typical tax treaty has about 30-32 articles. I've just grouped it for the purposes of our conversation. Application articles generally give directions on what kind of tax rates are allocated between two countries for different categories of incomes. I spoke about the persons covered, the kind of taxes that the treaty deals with, who is a resident, what is entry into force, termination, etc. Then you have distributive rules. These rules basically call out for items that are specific to each country in the nature of, say, interest, capital gains, royalties, etc. What kind of taxing rights are there between both these countries. The treaties also come with anti-avoidance provisions, inbuilt mechanisms to say if these transactions are with associate enterprises, what would be the law vis-a-vis transactions with unrelated parties? How will I be able to exchange information and collect taxes if I believe there is a evasion that is happening? How will I provide you relief from double taxation? If both countries levy a tax, will I be giving you a straight deduction of the tax that you paid in the other country? Or will I give you a credit? Or how will I ensure that your equity is paid? Lastly, miscellaneous provisions. These are just supplementing provisions to ensure that you have other sources or other mechanisms to ensure that your tax is not unduly collected. If you have a dispute, how do you settle that dispute? I spoke about the discrimination aspect, how between two countries, I spoke about the discrimination aspect as to how between two countries you should not be discriminated basis your residence, etc. Lastly, the application of the treaty, territorial extension benefits. Certain other aspects within the treaties that I would like to touch upon. As I spoke, the treaty is nothing but an agreement between two countries. So viewed in that context, how do you go about interpreting a treaty, especially if there are disputes that you would want to resolve? Now under the Income Tax Act, you have a series of judgment, law, jurisprudence to fall back on to aid your interpretation. You have specific rules of interpretation as to how you would look at deeming fictions, how you would look at specific fictions, etc. As far as the tax treaty is concerned, given that it is ultimately an agreement, at the purest form it is a contract between two countries. Once again, a treaty is to be interpreted not basis the rules that you apply for interpreting domestic tax laws, but the objective is to look at principles of good faith, which are also laid down in the Vienna Convention on the law of treaties. And in that context, to aid interpretations in tax treaties, we rely on supplementary sources. I spoke about model tax conventions and model articles that we have seen, which have evolved into the formats of the treaties that we have seen so far. The OECD and the UN publishes their commentaries on specific model treaties for each article. These OECD commentaries have been relied upon by Indian judiciaries and even the Supreme Court to assist in interpreting and understanding the position between two countries as far as tax treaties are concerned. So net, you don't look at it like a principle of law. Rather, you would rely on these secondary sources or supplementary sources or commentaries to aid our understanding in terms of what would be the principle that we should be following when I look at interpreting a treaty. Net, the agreement is only intended to ensure that there is a fair share of allocation and there is a fair taxing right between two countries. And therefore, viewed in that context, certain specific scenarios or specific situations that we come across should also be seen from a common law standpoint and the intention by taking aid of these commentaries to see how we would be able to fit them to our context and fact pattern. And like I said, the OECD commentaries by itself have been upheld in several Supreme Court rulings as well to be a good tool of interpretation as far as tax treaties are concerned. Now, interestingly, India is not a member country of the OECD. It rather only has what is called as an observer status, which means I necessarily don't sign up to whatever the OECD is saying as my position as well. But I will observe and I will put in place my reservations if I have anything, if the commentary is not agreeable to me. For example, if the OECD says that merely having a server in another country does not mean you have a PE. India can have a reservation to that to say, I do not agree with this position. It can still lead to a PE if ABC conditions are satisfied. Now, if I were to advise someone in this kind of a scenario or a fact pattern, where India has expressed a reservation on an OECD commentary, typically the approach would be to say, okay, the commentaries talk about something, but India has reserved or India has made its position clear as far as that particular commentary is concerned. How do I go about, therefore, giving the benefit of the treaty to the other person or not? Here is where, once again, we go back to first principles and jurisprudence. Essentially, putting in place a reservation on a commentary does not have the same effect as altering the tax treaty itself. And so, therefore, merely because I have a reservation on a commentary cannot be taken as a means to say this will not be the tax position or this will be the tax position in India for that particular item. It merely represents India's stand, and unless the treaty is amended, we can still continue to go by the commentaries, give that benefit, unless there is a clear evidence of the subsequent amendment to the treaty happening pursuant to that reservation that we speak about. So, in summary, don't look at it like a very rigid document or a law that you would look at each and every word and try to interpret the meaning, look at every comma, full stop, etc. But try to look at it as an agreement that two countries have crafted, with the intention being more paramount here. Supporting that interpretation would be these model commentaries that we spoke. The second aspect, and this is the most interesting thing that has happened in the recent times, is the Supreme Court ruling in the case of Nestle SA. Now, this sort of ties back to the overall theme of our conversation as well, in terms of going back to basics. Now, until the Supreme Court ruling, the way tax treaties are being seen, as I said, there is an entry into force in any tax treaty when the treaty comes into effect. Now, the treaties have not just the main articles but also separate protocols to say, in certain situations, if ABC happens, I will give you a more beneficial tax treaty. Historically, for the last couple of years, I would even say for the last decade or so, the understanding has always been that once a treaty enters into force, it completely comes into force with all these protocols, all these annexures, supplementary documents, etc. And if the treaty gives a benefit, if the treaty says, look, if ABC happens, I will give you XYZ benefits, that comes into effect automatically was the understanding. The context here being, certain treaties that India has have what is called as a most favored nation clause. I will just touch upon this topic for a minute. This is again a separate conversation by itself, but as a concept, the most favored nation clause says, if I and you have an agreement, after my agreement, if I enter into a more favorable agreement with a third country, and if the third country falls within a particular set of rules, then I will automatically give you also that favorable treatment which I had with the third country. I don't have to separately come and notify anything here, was the understanding. As long as the third country gets a better treatment from me, you will also be entitled for that better treatment from me. This in summary, in a very simple term, is how the MFN clause operates. The Supreme Court has interestingly picked this aspect to say that the protocol to any tax treaty also requires a separate notification, has to go through the entire process that I spoke about some time back, and only after then it comes into effect. This basically means that in any treaty, therefore, the treaty first has to come into effect, and then if there is any supporting paragraphs, protocols, such beneficial provisions, etc., that also has to go through a process to come into effect. And it is only after all these procedures are completed, you can start getting the benefits of these favorable clauses that I spoke about. So in a nutshell, therefore, the Supreme Court has pushed us back to a fundamental understanding of when will a treaty become effective, what procedures are required to make it effective, and from when can you start extending these benefits in specific transactions. And again, these become critical as we evaluate the treaty. Again, going back to my example of a simple 15 CSEB transaction, when I look at the treaty, therefore, holistically, it will also be important for me to go back and understand if I will get these benefits as long as these have been notified, have they been notified, etc. etc. The third aspect is the supremacy of tax treaties. Now, I think I briefly touched upon this when we started speaking, so you also raised a point. Essentially, the tax treaty and the domestic tax laws, wherever there is a conflict, the settled position is that the treaty will override. So this is why, like I started off saying, any foreign entity that wants to do business in India is better off reading a simple tax treaty over 300 sections of the income tax law in order to understand its position, in order to understand its tax implications, etc. But very interestingly, the way the tax law is worded is to say that the provisions of the Indian income tax law would apply to the extent they are more beneficial to the non-resident over the tax treaty, which essentially, from a very technical sense, would mean that you first get into the income tax law, go through all the 300 sections, then compare the tax treaty to figure out what is beneficial. But net-net, the messaging is clear. As long as you are able to satisfy all other aspects that I spoke about, your ability to get a tax residency certificate, you are having sufficient substance, you are being covered as a person, etc., the tax treaty becomes more beneficial to you if there is a transaction and there is a conflicting position. For example, the tax law levies a 20% withholding, but the treaty levies a 10% or in some cases 5%, etc. All of these provisions come to you only by virtue of this tax treaty supremacy. And as a principle as well, this has been upheld in again several jurisprudence. The last point is the impact of the multilateral instrument. As I spoke about increasing focus on substance and enhanced scrutiny of the tax avoidance strategies employed by MNCs by taking advantages of favorable tax treaties, treaty shopping, etc. The OECD has been running this base erosion and profit shifting initiative targeted to combat such structures and ensure that there is again a fair share of taxes that are paid by companies in whatever jurisdictions that they operate. The multilateral instrument is one such initiative which the OECD had come up with to put in place more stricter conditions to be able to get benefits under tax treaties and stricter conditions to get access to favorable tax positions. This is critical because as an instrument, with just the countries signing up to this one particular instrument, more than 2,500 bilateral tax treaties have got amended. So it is not just the regular tax treaty that we look at now. We should be looking at the treaty as amended by the MLI. And within the MLI as well, there are several sections where a particular country may not have agreed to a clause, the other country could have agreed, both countries could have agreed, but to different aspects of how the income should be subjected to a credit or a deduction, etc., etc. And therefore also it is critical for us to be aware of these provisions, how they interplay into the treaty that we are reading with, and ultimately ensure that the access to the treaty is justified, the genuineness of the transaction is justified, and the benefit that we are giving is coherent with the principles set out in the MLI. I will pause here if there are any further questions.
Where do you get the authenticated double taxation agreements?
So,
search and take one copy of it.
So you could use the material available on the income tax website itself. That is pretty updated. You get the base treaty as well as the treaty amended by the MLI as well. It has updated.
You do not go into Google and search and sometimes we go into Google and look for some taxation. I don't know whether that is a final one or a further amount. So ID website is the latest update.
Absolutely. ID website is the latest and more secure.
What is the impact of Supreme Court ruling in this case, right?
Sure, sir. So in summary, what I wanted to convey here was, I spoke about when a tax treaty comes into force, what kind of activities are needed. The Supreme Court has gone one step further to say that within a tax treaty, as far as the regular articles are concerned, we are fine. But there are specific and special protocols also that are sometimes inbuilt into the treaty. These protocols have to go through a separate notification process to be coming into effect. That's in a very summary term what the Supreme Court has said. Why it is relevant is, if I look at a treaty therefore, I read the main article along with the protocol, I would have been taking a position prior to this ruling. But the impact now is, pursuant to the Supreme Court's judgment, you need to ensure that the protocol is also separately notified to be able to take this benefit.
So the emotional clause is not applicable. You can't apply emotional clause separately because that should notify separately the clauses.
My point is actually in that side. The Supreme Court ruling was in the context of MFM process, where it looked into protocols in tax treaties to make out a case that the protocol introducing the MFM clause itself has to be separately notified. And only after that notification process is done, it becomes treaty. It becomes law.
Unless it is notified in the protocol, only is applicable.
Correct, exactly. What we used to do earlier was when a treaty gets notified, we understood it to be notified in entirety, including the protocol, including the MFN clause, etc. So in that situation, what benefit
the nation has you are taking this benefit for this country, that cannot be done.
Exactly, you are absolutely right. So if the other country has notified it, and we haven't notified, it still means that you cannot take the benefit. The other country can give this.
But what is the use of this emotional clause? Unless you go into all the process, you are redundant actually.
Yeah, so the way the Supreme Court has told it also, has looked at it also is in the same lines. They are saying you follow the legal procedures required to give effect to it, and then you go about giving it. And if the government has, in its wisdom, not done it, then it means they have not done it for a particular reason. Until then, you cannot give this benefit. Simple. So, like I said, I just wanted to give you a first look of this topic, given that there is a sufficient and vast material to cover, even as much as say 20 seasons of a web series in this situation. So, if no further questions, we can pause here, take a break, and then I can start the second topic.
What's the second topic?
Overview of section 5 and 6.
I work in multilateral taxation. I have tax, taxation. That tax was conceptualized only for then I tried an offer for job. I was able to see the process. gap. It's not covered in this information. So they're saying problems created in India. The gap is right now can takes profit out for India. India gets damaged. Profits are not American. So there's a 2022 community process. They by name regulation is a solution for China obesity and then yoga is a solution for combating episodes. So the because you mentioned one thing, yoga is not a practical taxation. By electronic innovation is the market tax. So from here, we differentiating how do you get into contact with KUMAR or because we are getting the package of McDonald's, KFC, pizza, and food, all related to obesity. Market change. So those are the things because all the various shops, a lot of meat, very effective. So they don't say there's an ethical content how McDonald's and creation. So I think the original is not a solution for the first one. Tax design was not practical tax. So design so we take cool drinks, chili experience, caffeine, sweetness, flavors, colors, and then zero. And 6 factors. Apart from that, there is this cost, 8 factors. That's not the 3 more factors. The child birth arrangement, these are 15 influences. Markets fell. There are 2 jobs available. One is markets fall, companies will go back, and then you do investigation evidence. Or you do a global economic project. Then I start working with local messages. What you can do is logging I've been successful in building shipping a company. Just because I shipped it, I could be the first one to get Indian knowledge. Engineering. 40K. The yoga day was devoted in 6 months. We had involving patients. Then it became as a declaration. But the field we recognize that we want to do it. It's very hot topic cover. Then we have to other problems also. The negotiation other problems. But the government has said that the government, international people ask for knowledge of yoga-based taxation. My work is to go on the front of the government. That's how I got now. The career is interesting for 16 years I've been there. There's no way. But it's satisfactory. I just have I want to share a company because I shared it. Design. So people are telling me, Prime Minister, because he came and he started work in 2008 and he came in 2014. And my making because Saturday, ticket, most of the transit, I was talking about transit, different agent. This is a big study to traveling. No, the finances will come, I don't know. I was very curious of this one. What is the cost? Government has to become ready for it is covered. Actually, it is established. The flood is closed. We need to provide for the bringing land to social facilities. So that way itself, we can pay some money to bring the customers of the international taxation. This book is not about finance. I was very curious to know.
It down to just some interesting concepts or takeaways that I want to share with you all on these sections. So section 5 talks about the scope of total income that is subjected to tax. Before going into 5, the charge of income tax comes from section 4, which speaks about how the total income of every person for every previous year is subjected to tax as per the rates given in the Annual Finance Act. And this total income, these two simple words are enshrined in section 5. The definition of total income under 245 has two limits. One is a reference to a scope in section 5, which says the total income as referred to in section 5. And then there is a computation mechanism as per the provisions of the Act. So it gives a complete code in itself to say, under section 5, whatever becomes income, as long as there is a computation mechanism attached to it, that together becomes total income for the purposes of income tax. Now within these two simple frameworks, section 5 operates as an overall blanket to say what are the various kinds of incomes, what are the various categories of incomes that would be subjected to tax in India. Okay. But if I were to break down section 5 into just two broad themes that I would like to speak about today. Like I said, it speaks about the scope of total income, which basically means any and all kinds of income that accrues or arises or is received or deemed to be received by a person from whatever source is said to be taxed in India. Now, at a first blush, it appears to be quite simple and innocuous. But we'll just pick apart two specific themes here and then see how various issues can come. The first issue in section 5 is the concept of a source of income itself. So section 5 says all incomes from whatever source received or deemed to be received, accrued or deemed to be accrued, etc. is taxed in India. Now here, what exactly do we mean by a source of income? In a very simple term, if income is looked at as a fruit from a activity or an event, etc., the source is essentially the tree from which the fruit comes. So there should be a first degree nexus between the income and the activity that gives rise to the income. But here is where at several times there is a very thin line of difference and there is an overlapping situation as to what could be the source. I'll give you an example. If you take rental incomes, what would be the source of that income? Our immediate reaction may have been to say that the underlying property or the house property is the source because that is the instrument from which I derive the income. Very interestingly, the instrument that gives you the income is not the same as the source for that income. The source of your rental income is your rental agreement with your tenant, which gives you the right to go knock his door and say every month I will come to you to get a particular amount. Right? Similarly, if you look at business incomes, where your business is the instrument from which you derive that income, essentially your contracts with your clients, your engagement letters with your customers, all of these becomes your source of that particular income. Which is why in past jurisprudence, if you were to sell a business by itself, it is not called as a source of income going away. It's a capital asset that goes away, you end up paying taxes on it. But if you were to hive off or give away your income generating contracts, that would be seen as a loss of a source of income itself and not a loss of a capital asset warranting no taxes to be paid on this. So net therefore, a source of income is different from the instrument that generates that income. And you would need to look at the first degree nexus between both these things. This is again critical because under section 5, the fiction that is created is whatever be the source, as long as the income is received or deemed to be received in India, that income is subjected to tax in India for a resident. So we've established to some extent what could be seen as a source for a particular income. Now in that context, if you were to slightly extend this to say, the rental agreement in my example is a source of income, but I don't have the ability to come into India to exercise that agreement. This is an agreement which can be exercised say only in Singapore. I will have the right to enter that agreement, make my rights in Singapore, etc. Technically speaking, the place where your income therefore accrues shifts from the source. While your asset may be in India, technically your right to receive that income moves out of India, goes out somewhere else. This is why the provisions or the language in section 5 has a deeming fiction to say that certain kinds of income or certain categories of income are deemed to be therefore accruing in India as far as the asset or the source for that particular income can be seen to be in India. Similarly, I also spoke about the concept of income receiving or deemed to be received under section 5 and also income that accrues or deems to be accrued under section 9 come together to form the overall scope of total income within which tax is therefore applied. So if I go to that framework, I will just take upon the concept of received or deemed to be received to start off. At the very outset, the way the section is worded talks about income that you receive. What do you really mean by income, or what do you really mean by receiving income? Under the tax law, income is subjected to tax, and that income comes into the tax net as soon as a right to receive it gets established. So what you receive is technically, is it an income in the very technical sense under the tax laws, or is it merely the consideration for your efforts or services that you are receiving? Net, the point that I am trying to make out is, the language used talks about a receipt of a particular income, but for you to be calling that out and saying that you will tax any income on receipt basis is not the same. For example, merely because you follow say a cash basis of accounting and you receive an advance from your customer for a particular work or a particular activity, you would not call that as income that you would subject to tax because you have received it. What has to be seen is whether the receipt that you have still crosses that threshold and becomes income in the first place from a very technical sense. for you to even apply Section 5. So if that's the case, then where exactly would you apply this principle? What would you mean by incomes that you receive? These are very specific fictions under specific provisions. For example, you receive a gift from a non-relative. There, what you receive becomes income only after you receive it in monetary terms. Until then, there is no right, there is no ability for you to go demand a payment, etc. And therefore, this aspect of received or deemed to be received should not be seen in a very colloquial sense to say that whatever I receive becomes income that gets subjected to tax. Rather, the test should be is what you have shown income in the first place, and then the question of the timing of the tax comes into effect. So from that point of view, your method of accounting, accrual or cash, etc. also plays a significant role. Merely because you follow cash basis of accounting doesn't mean that whatever you record as receipts become income in the first place. And you will still need to go into the provisions of the law to look at this interplay and touch upon when will this income be subjected to tax in that instance. Lastly, the way the section is worded, even constructive receipts are said to be income. Because if I were to receive an income from X and X was to receive something from Y and Y pays me directly, those kind of transactions are also covered within the specific ambit of this provision. So from that point of view, this aspect of receipt or deemed to be received should be seen only in the context of whether you have already earned a right to receive that particular item of income, and thereon what you receive is only an obligation getting satisfied. It is not a question of merely a change in the perspective to say that now that I have received it, it becomes taxable to me, and therefore if I follow an accrual basis or if I change my method, etc., I would be able to defer that tax system to a different point of time. This is just a very high level overview of the implications in Section 5. There would be several other purely legal aspects to it as we delve along, and therefore in the interest of time and in the interest of keeping this more interactive, I am not touching into all those other legal aspects. On similar lines, the other ambit, the question of income that is accruing or deemed to be accruing or arising in India, also has several independent and nuanced interpretations that come from Section 9. As that is not a topic for our conversation today, I thought I will limit our discussions only to these specific principles that I want to take. Net, the implications on the method of accounting become critical. Merely because you show something as received does not mean it becomes income. You will still have to show that your right to receive it has become established for you to call that receipt as a taxable event and pay tax on it. I'll move to Section 6, residential status of various categories. I've just put this precisely for completeness purposes. I'm sure all of you here know this better than me. In terms of individual tax residences, how do you determine who is a resident, who is a not orderly resident, etc., number of days stay, etc., etc. The aspect that I would more like to speak upon is the concept of place of effective management, which is the amendment that has come about for companies and the way it will come in their residential status. So under the tax law, an Indian company is always deemed to be a resident by default, by virtue of its incorporation. Historically, foreign companies were deemed to be residents in India if the control and management were held to be in India, which meant if the head and brain were to be said to be present in India at all points of time, those foreign companies by virtue of that fiction could become residents in India. From 2016, the law got amended to say that a foreign company can become a resident in India if the place of effective management of that foreign company is said to be in India. The concept of POAU emerged to therefore mean a place where the key management and commercial decisions for conduct of a business in substance are getting made. So this means at major points of time, major activities, business decisions, aspects that are crucial for the organization as a whole are said to be happening out of India. These foreign companies could end up being tax residents of India. I'll give you an example. Practically, if you look at our clients, you may have operations overseas. Right? You may have Indian holding companies holding operations in Dubai, holding all businesses in Singapore, etc. through subsidiary organizations. In most cases, typically, these subsidiaries would not have independent teams. They will not have independent finance, legal, HR teams, etc. All of them get centralized. Work happens out of here. You may be seeing authorities here signing checks on behalf of those entities, even small things like getting tax compliances done for those entities sitting out of here, etc. All of these may end up being seen as situations where business decisions for these companies are getting taken out of India, essentially. And over a period of time, as this gets established or as this gets set as precedent, it is very easy for the department to then come and make an allegation that this company is effectively being managed from India, and therefore this company is a tax resident of India and ought to be subjected to Indian tax, as we see. That's where the concept of POEM is gaining prominence now, with groups looking at this more seriously and ensuring that what they do on the ground is also reflected adequately in the paperwork that they put in place. Given that this is a very abstract concept, right? Like I said, you could have several activities that are done here for centralized purposes, for convenience, ease of doing business, etc. The CBDT came out with a set of guiding principles to provide a sense of direction as to when you would look at POEM getting satisfied in India. These guiding principles clearly came out with some parameters, objective and subjective parameters, with the intention being, here are certain tests that I want you to look at. As long as you meet these tests, we are okay. We will not come behind you for each and every fact pattern, and unless that you have a POEM in India. So the CBDT's clear directive is, you don't look at the paperwork or the form that is happening, you ought to look at substance. And at the same time, operational decisions in terms of day-to-day businesses are not relevant for me. What is relevant are key managerial and commercial decisions which are critical for that business operation. If that gets taken out in India, that becomes a key red flag for me to evaluate POEM in India. The objective tests that the CBDT came out with are twofold. To check if you have what is called as an active business outside India. Essentially, they have given us a set of formulae to evaluate what kind of income I earn, how much assets, how many employees, and what kind of payroll I have in these foreign countries. And as long as I am able to show that my spend on all these activities are more than at least 50% okay, of my total spend, my total income, etc., it is deemed that I have an active business presence outside India. These being objective criteria, they have also mentioned here that you need to look at the data sets of the last 2 years to ensure that there is a clear flow that is happening and you don't put in place a fly-by-night structure. But net-net, you satisfy these, the first presumption is, okay, we believe that you have an active presence there. What next? The minute you satisfy this condition, they have said that we will look at your board meetings. If the majority of your meetings are being held outside India, then we believe at a first blush that yes, you have satisfied all conditions. Then we will look at the powers of your board. Is your board competent and capable enough to be able to take these decisions, or are they merely rubber stamping something that is being put in place from some other person? This is a slightly subjective criteria, but net-net, as long as we are able to show that the board is capable, they have taken their own individual decisions, they have their own competencies, etc. The tax department's view is also that POEM we believe is outside India, unless there is significant evidence to the contrary to suggest something else. The next condition is a subjective criteria. Now, what happens if you don't satisfy the ABOI test, or you satisfy the ABOI test, but you now need to come and showcase that your board is competent or capable enough to take these decisions? Here, the CBDT circular itself gives certain principles and certain illustrative scenarios to evaluate what kind of activities would go on to show that your board or your management there have significant powers and capabilities. They essentially want to bifurcate this into two aspects. One is how the decision making happens. Right? Do you have people attending board meetings physically? In those cases, where would decisions be taken? Or do you have people merely attending meetings on electronic or video conferencing modes? In which cases, how would decision making happen, etc. The second place is where these decisions eventually get taken. Here, the directive is you look at typically the places where board meetings are held. We will assume that if a majority of the meetings are held in a particular jurisdiction, by default that becomes the place where decisions get taken and where POEM is said to be exercised. But if you have situations of people attending meetings through video conferencing, if you have situations where the head office sets in certain specific policies or practices, etc., and these are just getting implemented in meetings, then how does decision making happen? All of these are again illustrative guidelines or parameters to evaluate, but in sum and substance, the way in practice companies look at it is to see what, number one, is the key business or commercial objectives of my overseas operations. This is specific again to each business, each operation, each venture, etc. And second, how does this get translated in terms of decision making as far as the management of that operation is concerned from an Indian tax standpoint. And here, like I said, your substance and form have to coincide. You would need to be able to demonstrate that my board there is independent, not merely because I've given them some powers and they have been able to sign off on some meetings, but do they actually have the competence and the capability to even override me as a shareholder? Do they have the ability to take a decision independently if I am not involved? What kind of authorities have I given them? What kind of scenarios are there where they have vetoed a decision that I have taken, etc. All of these become important factors to have in place to be able to show and bring out a defense to say that my poem for a foreign corporation is not situated in India from a overall quantification or a qualification standpoint to test the aspect. We'll pause here again if any questions, or I'll keep going. Feel free to stop me asking.
So if at all a company becomes like due to this poem condition, if it fulfills the poem condition, becomes a resident in India, then that foreign company will not be eligible for the treaty benefits. No?
So yes, you are right. By virtue of poem, if they become a tax resident in India, by default they don't get access to the treaty. But at the same time, what happens is technically, whichever country you are otherwise incorporated in, if that country and India have under the treaty a mechanism where we say that you will end up doing, say, a discussion between the competent authorities, or you will do some further checks under the treaty to say, okay, under India tax laws your poem is in India, but under the treaty is there a mechanism to again say that your residence is not in India, etc. Those secondary tests come into question.
So in that case, treaty will prevail over the income tax laws. And one more thing, in your previous slide, you were showing the test factor, no, for PO, the previous one. So in case of that global shared service center, so so in case of shared service center, all these conditions will indefinitely meet. Like if a shared service center of an MNC company of US is having a base in India, so most of the predominant activities will be carried out in India. Right. So it will fail all this test actually. Employee count, if you see, basis the cost input, they would have deployed their entire workforce in India, for example, in that case. But the decision making, all other board of directors and all other things will happen outside India. Only they fail in this test.
So in your example, that GCC, is it set up like a subsidiary under the MNC in India?
It's like a separate division, shared service division, and that shared service division comes from India. They have an office in India and they work from here for a client sitting in US or Europe for that.
So like I started off, see, poem is typically applicable only to foreign corporations. Okay. So the shared service center, setting up a captive subsidiary in India that caters to the need of a parent is a very common fact pattern. Okay. And if you are set up as an Indian company, by default you are an Indian tax resident. So this and that don't get interplayed there. This becomes relevant if you are foreign client, for example.
Okay. My view is that independent that shared service center cannot take any decision of its own. It's just working mirror company, like working for its parent company. Typically, it doesn't have any substance in India.
No, fair enough. I'm saying anyway it's a tax resident of India, and therefore whether it takes decisions on its own or it goes back to the parent for approval for anything doesn't matter. The income and losses etc. get anyway subject to tax in India. This becomes more relevant only in a reverse scenario. If say your Indian headquarter has a shared service center, say in Philippines, okay, and that shared service center for everything has to come back here, then for that Philippines entity, you would start applying all these tests to see if that becomes a tax resident in India. So under section 6, basically, if you are an Indian company, by default you are a tax resident, which means if you are incorporated in India under company law in India, etc., you become a tax resident.
So reverse scenario, this just becomes more relevant.
Yeah, reverse scenario, this becomes more.
It's likely that most of these tech companies having sales offices outside India may fall under this.
Absolutely. So they have given a threshold. They will not apply this law if your turnover does not cross 50 crores in a year. But the minute you cross, it becomes very relevant.
So it would have been possible that fresh works initially would have fallen.
Possible, very possible. Several of our trading clients, for example, may have a simple distribution setup in UAE. Okay? That entity may just buy here, sell there, it will not have any other substance. But because of the volume, the turnover exceeds, this becomes relevant immediately.
Is it like I should satisfy all those three? Like employee, asset and...
Yeah. All of these are inclusive conditions. So you satisfy everything, we deem that you are having active business outside.
So in our case or in your example, you may not satisfy asset or an employee list, right? Or
Right.
it will be less. Okay.
And mind you, this income that we have spoken about here is a taxable income also. So the circular has formula, it has how do you compute all this, etc. But in summary, it's a mix of objective and subjective evaluation. The subjective part gets more weightage at a lot of times. So the circular is itself clarified. So we spoke about this. Merely because you are a 100% subsidiary, I will not automatically deem that you have a poem here unless you are clearly violating all these conditions. Okay. Merely because some of the directors are resident in India also, they have promised to not take a serious view and say the poem is in India. PE in India of a foreign company, this is again a slightly technical concept. Essentially, if the foreign company operates through a branch office or through a sales office, etc. in India, that is a separate taxable entity on its own right. They have clarified that merely because you have such an operation would not mean that you have a poem in India for you to be subjected to tax. The other two are also similar friendly conditions basically. That merely because you have certain local management here, you have some centralized functions here, all of this by itself will not lead up to the poem evaluation. You need to go one step further to show that your key decisions or major activities are being taken out of India. Now, while I have not put a separate slide for this, essentially what happens is if your poem is deemed to be in India, then you are called out as a resident for India tax purposes. But at the same time, you are treated as a foreign company for India tax purposes. So this means that the applicable rate of tax goes up to 35% now. And you will be cast upon to do all compliances that a Indian tax resident foreign company should be doing, which means you pay advance taxes, you have to do TDS, you have to maintain your books under these ICTS provisions, file your quarterly TDS returns, full year returns, etc. etc. And associated penal consequences also will start applying if you don't do this. So again, basically, it will be relevant for us to go back and any of our fact patterns, if there is an evidence of these kind of overseas structures being put in place. Even if the turnover of 50 crore is not met in any year, it will still be important to at least look at these governance aspects and ensure that these governance aspects are already in place so that it doesn't look like a inorganic shift to something merely for tax avoidance purposes, but rather something that is always in place if there is a questioning or a line of scrutiny on this point. So while there has not been a lot of furor or a lot of assessments happening on this count, what we are beginning to see is that the department is beginning to use this. They are looking to use general anti-avoidance rules, etc. as newer weapons in their arsenal to start looking at structures holistically and then trying to bring incomes into tax in India. For example, we were looking at one jurisprudence where a Mauritius-based company's financial statements were adopted in an annual general meeting in Mauritius, but the directors who attended it came by way of a video conferencing from the US and approved their financial statements. The ruling held that since this is a very important activity for any company, because the activity did not happen in Mauritius, the entity is not a tax resident of Mauritius. So something as simple as this also could lead to a situation, right? So again, juxtaposing with our example, if I have a Dubai operation, a very fundamental thing that we tell our our companies is to have this as a basic hygiene. Even if you're approving financials, do it in Mauritius. Have a meeting there, do it there. So that there is no such allegation, and then you begin to start building your case to say, no, this was a one-off case, there is no such situation, etc. etc. So we will begin to see a lot of action on this as we go along. And from that point of view, it is important to start preparing things, especially in this kind of an era where clearly there is a lot more cross-border businesses, global businesses happening from Indian organizations. That's it. I don't have any other slides to bore you. I'm giving you back almost an hour of your time in that time. Any other questions or thoughts we can speak, or we can.
We'll come to class.